The Federal Reserve continues their war on inflation, and as Powell continues to hike rates to keep this under control, with 75 basis point rate increases becoming an almost monthly occurrence, one major victim is the housing market, with mortgage rates reaching a 12-year high and mortgage applications hitting a 3-year low. With such drastic changes, the mortgage market is taking a beating, and one stock I've been covering for a while is UWM Holdings, the #1 wholesale mortgage provider in the US. Q2 earnings are out, and with the stock down a whopping 47% year to date, it's time I gave an update on the company and whether it's still a good investment. Here we go. Following COVID, macroeconomics and political turmoil, the cost of living continues to rise and house prices are at an all-time high. And between the UK and the US, house prices rose by an average of 15.9% over the last year. After years of banks, landlords and government-backed Help to Buy schemes pushing up property prices to a point where many potential buyers, particularly millennials, have been priced out of the market, and any chance of saving for a mortgage has been crushed by lagging wages and excessive rent amounts. It's a depressing fall for anyone who dreamt of owning their own home. According to data from Fannie Mae, a US government-backed mortgage association, housing sentiment, that's the share of people who think it's a good time to buy a home, fell to 25% in January, a record low. However, the data, and there is loads of it, has various projections about the state of the housing market. But the bottom line is that after further price rises in 2022 and the likelihood of a recession brought on by tightened monetary policies, prices are predicted to reach a stalemate in 2023. And when you have a combination of peaked house prices and high mortgage rates, there's a high possibility of a much needed correction. The Global House Price Index reports that global house prices are rising on average 9.2% over the last 12 months, and looking at the UK, that figure stands at 13.2%, whereas the US is seeing 18.6%. But if you want to see house prices come down, you could always move to Spain.
Ay, caramba!
But contrary to that data, if we look at mortgage rates over the last 50 years, they have actually gone down over the long term. Because as house prices climb, customers are looking for lower rates, and the mortgage industry has been working to provide this. But the strain of modern living has been tough for many households looking for financial security. Homes just aren't being built fast enough to meet demand or lower their value. So when it comes to mortgages, rates are going to be more important to anyone considering buying a home. It's for this reason that the mortgage broker market has taken off over the last few years, as consumers look for the lowest rates on the market, and it's through this channel that United Wholesale Mortgage aims to lead the way. The company entered the market in January 2021 via SPAC. Unfortunately, many companies use this method to skip the traditional IPO process in favour of fewer regulatory requirements, lower fees, bloated valuations, and faster access to capital from investors. This has too often resulted in those companies being incapable of making effective use of the capital raised by investors, which has too often been money down the drain of loss-making companies who should never have been on the market to begin with. You can't polish a turd. But a good investor looks for a diamond in the rough, and despite unfavourable market conditions, UWM seems to be one of the few SPACs worth their salt, forming their own path, largely due to the highly motivated and aggressive strategy from CEO Matt Ishbia, who aims to make UWM the #1 mortgage broker in the US. Here's a breakdown of his strategy so far. CEO Matt Ishbia is hell-bent on mortgage market domination, using a strategy of gaining market share by improving technology, customer experience, and providing the best rates on the market. As with any business, the implementation of technology has the potential of replacing the slow, tedious, multi-party mortgage application process with a more streamlined, innovative, and automated process that keeps costs down and passes those savings on to customers. But it sounds very much like fintech, an industry which has seen a very public rejection by investors who don't see technology as a safe investment during times of rapidly rising interest rates and cutbacks in production. Despite this, UWM continues to innovate, and in addition to technologies introduced over the last 2 years, in June the company announced Boost, a selection of features to assist mortgage brokers in managing their businesses more effectively by improving communication with their agents and clients. It includes Brand 360 live transfers, which gives brokers access to have their past clients called on their behalf and then live transferred directly to them. Lead Connect allows brokers to purchase leads at a discount that they can then tailor to fit their business needs and budget, with the option to have those leads called and live transferred directly to them. Agent Connect, where UWM will identify potential real estate agent partners in the mortgage brokers area and schedule one-on-one personal meetings on their behalf, and also provide successful follow-up strategies. And then we have Partner Academy, a free online mortgage training system for brokers. The company introduced their Game On initiative, which aims to grow their market share by attracting more brokers, convert more loan officers, and generate increased website traffic to UWM's induction website, beamortgagebroker.com. The program aims to drop rates across the board to help their brokers gain ground in a competitive mortgage market, and with this service, Uppbeat is expecting the broker market to reach 40% within 5 years and double their share of mortgage applications. In addition, their continued technology services has helped reduce turnaround times, with UWM's Q222 report stating a clear to close time of just 19 days, compared to the industry average of 44 in the last quarter, which is a significant advantage in the broker market. As regulatory costs and reduced volumes continue to chip away at the industry, mortgage companies are suffering, and we are going to see some consolidation in the future. Matt Ishbia has stated repeatedly since IPO that as mortgage rates go up, they would be in a prime position to take the lead. He considers their last quarter the best one ever. But we don't have to take him at his word, because I've gone over the financials. Comparing the top US mortgage providers, the last 3 years of data shows that closed loan volume of these companies hit a peak during the pandemic, and the figures have been coming down since, coincided with changes in the market and poor consumer sentiment. But what we can see from data on the left is how some of the underdogs of the market, UWM, Rocket, Rhythm, Loan Depot, have made great strides in their annual volumes compared to their larger rivals. If we look at the average gain margins, that is the margins they earn on their loans, we can see that these same companies are amongst the lowest rate providers, with UWM operating with the lowest gain margin in the industry. This suggests that the company is able to operate on much smaller margins, and although this eats into company profits, this was a strategic move in growing their broker channel and market share, and demonstrates their ability to operate in a challenging environment successfully. But investors seem inclined to favour the results of quarterly earnings over the long-term strategy of the company, and with the stock down 47% over the last year, there is clearly some doubt on their growth potential. If we look at loan originations, we can see that UWM reported just short of 30 billion in Q2. That's a 23% drop from Q1 and a massive 49.53% decline from the 59 billion the year before. If we consider their income, their 564 million revenue is up 16.42% from last year's 484 million, and although the increase in net income to 8.36 million seems small, this is due to shareholder stock representing just a fraction of the company, due to the unique nature of how the company came to market via SPAC. The company as a whole gained 215 million net income from their operations, but the majority of this went to Matt Ishbia's non-controlling interest. UWM are not the worst in the group, and in fact I'll be more concerned about Rocket Mortgage, who seem to have fallen far from their performance highs. Additionally, Loan Depot have suffered significant losses in their last 2 quarters, and they just announced their Vision 2025 plan, where they will be making strategic decisions to exit the wholesale business, reshuffle their board, and suspend their dividend, with further cuts planned in personnel and marketing costs. By comparison, UWM continues to drop rates, and they've introduced new programs to their brokers. The stock might have fallen from its 2020 high, but one benefit to consider during a stock sell-off is that the remaining stock becomes more concentrated, meaning earnings per share, which is calculated by dividing profit by outstanding shares, has risen 28.6% from 7 cents per share to 9 cents. In addition, the board are continuing their ongoing dividend of 10 cents per share, and with the stock trading at $3.95, represents an annual yield of over 10%, and much needed assurance and compensation for investors who love a dividend. So this creates a dilemma, because on one hand we have a stock trading far below its high, but despite the 47% drop and some recent volatility, the stock seems to have found some level of support since June, trading sideways between $3 and $4 and climbing since last earnings. But if we consider the intrinsic value of the company, UWM has done a good job of growing and holding their asset value. Costs have been incredibly consistent, around the $350 million mark each quarter, and the company is holding cash at consistent enough levels, so they haven't had to take on massive amounts of debt to get by. The financials show that UWM are resilient and able to continue operations within their current margins, and although this hasn't protected them from problems in the overall market, the stock does seem to have bottomed at the current price and makes an intriguing entry point. The mortgage market has some rough times ahead, and whether a correction is on the horizon, there's a good chance it will be a more consolidated industry in the future. UWM continues to intrigue me as a business model, and I like Ishbia's enthusiastic and innovative approach, as in addition to delivering on their business model, he's shown tremendous foresight by predicting where the market could be heading and investing in the business to ensure UWM was prepared for a challenging environment, certainly more so than his rivals. The stock has had a rough ride over the last year, but this isn't unique to the mortgage market, and there's a good chance we'll see more volatility in the future. But with US inflation recently hitting zero and a chance the Fed may be less aggressive in the future, the stock could have been oversold. Having spread my investment over a 14-month period, I'm currently seeing my position in the green with a 4.77% return, which isn't much, but I'm more confident in investing now than I was when I started. In a struggling mortgage market, UWM continues to reinvest in their business and operate at the lowest margins in the industry, excelling where their rivals aren't. They have effectively thrown down the gauntlet to the competition, who can't bend down low enough to pick it up.
It's but a scratch.
A scratch? Your arm's off.
No, it isn't.
Well, what's that then?
I've heard worse.
You liar!
For that reason, I think UWM presents an opportunity to own a future market-leading company. Remember, rather than buying later, it's better to buy a company when they're on the operating table, and in UWM's case, they are building a business that could dominate the market within the next 2 to 3 years. As UWM stock bounces around the $3 to $4 mark, it seems to have found some support, and if they continue to improve on year-on-year results and maintain their yield, it's a dividend reinvestment stock I'm happy to hold. And that's my take, so if you have any thoughts or questions, please comment below, let me know. And remember, if you like what you see, smash that like button and subscribe. Until next time.